On June 12, 2026, something happened that had never happened in the history of human civilization. Elon Musk became the world's first trillionaire. $1 trillion. One man. For one brief moment, which was very strange, he had more wealth than any human in history. But less than 2 weeks later, it was gone. His net worth plummeted back down to a measly $946 billion. And in this video, we are going to prove something to you. How the biggest initial public offering in human history masked a multi-billion-dollar debt crisis. Why a stock can crash even when the entire market is legally forced to buy it. And why the richest man on earth briefly held a title built entirely on hype, artificial scarcity, and financial illusion. Let's expose what was actually happening beneath the headline. Let's go back to June 12, 2026. SpaceX launched its initial public offering, the largest IPO in the history of the stock market. It raised a staggering $75 billion. The stock was priced at $135 per share, and it immediately opened at $150. Investors were not just interested, they were desperate. Within just 4 days, the stock rocketed from $150 all the way to $225. At that peak, SpaceX was worth over $2.9 trillion, pushing Elon's 42% stake past the $1 trillion mark. History was made. But here is the secret the headlines completely ignored. SpaceX only floated 4.24% of its total shares to the public. Think about that. Out of every 100 shares that existed, only 4 were actually available to buy. When you manufacture artificial scarcity and flood the market with unmatched hype, prices go vertical. Not because the company is suddenly worth more, but because there is nothing to buy and everyone panics to get in. It is like selling 4 slices of a pizza to 1,000 starving people. The price per slice is not real. It is a panic. And what happened to the other 96% of the pizza? It was locked up, sitting safely with insiders, employees, and early investors. Just 4 days after hitting that peak, the illusion began to crack. The stock started falling, tumbling all the way down to $158, a brutal 38% drop. And then, Elon did something that stunned Wall Street. Just 2 weeks after raising $75 billion in the largest IPO in history, SpaceX went right back to the market and asked for $25 billion more in bonds. Imagine winning the lottery, walking out of the building, and immediately asking your friend for a loan. It makes 0 sense, unless you look at the balance sheet. According to SpaceX's own prospectus, the company has accumulated a staggering $41.3 billion in cumulative losses since 2002. The only division of SpaceX that actually turns a profit is Starlink. Everything else, rockets, space ambitions, and constant launches, bleeds massive amounts of cash. And what's worse, a major chunk of that new $25 billion wasn't for exciting future projects. It was used to pay off a $20 billion bridge loan that Elon had already taken out back in March, before the IPO even happened. They didn't need money for growth. They needed money to pay off debts they already owed. The market instantly realized the truth. The day the bond sale was announced, SpaceX stock dropped another 16.4% in a single session. On June 16th, SpaceX announced the acquisition of Cursor, an AI coding startup, for $60 billion. It became the largest acquisition of a venture-backed startup in history. How did they pay for it? Not with the cash they had just raised from the $75 billion. They paid for it entirely in stock. SpaceX directly printed brand new shares and used them as currency. Let's go back to our pizza analogy. When SpaceX went public, that pizza was sliced into a fixed number of pieces. But to buy Cursor, SpaceX didn't find any money lying around. They cut the pizza into more slices. This deal diluted existing shareholders by 3.4%. When you are dealing with a multi-trillion-dollar company, 3.4% represents hundreds of billions of dollars. Your slice of the pizza instantly got smaller, while the price you paid for it stayed the same. Following the Cursor announcement, the stock dropped another 20%, wiping out nearly $600 billion in market value. Retail investors were hit twice. The stock price crashed, and the value of their personal shares was watered down. Now you might be asking, didn't the index funds save it? This was supposed to be Elon's ultimate safety net. On July 7th, SpaceX was added to the NASDAQ 100, an elite index tracked by over $600 billion of retirement funds, ETFs, and institutional assets. Normally, a company must be public for 3 months before joining. But Wall Street bent its own rules and fast-tracked SpaceX's eligibility to just 15 trading days. When a stock enters the NASDAQ 100, every single fund tracking it is legally bound to buy it. There is no choice. It guaranteed tens of billions of dollars of forced automatic buying showing up all at once. And yet, the stock kept falling. This is the ultimate warning sign. When the entire market is legally forced to buy your stock and it still crashes below its original IPO price, it tells you a terrifying truth. The sellers are far more powerful than the mandatory buyers. Insiders, employees, and early investors were using this forced index fund buying as their ultimate exit door. Institutions bought, insiders sold, and everyday retail investors were left holding the bag. To make matters worse, trouble was brewing around Starlink, the crown jewel of SpaceX. On June 29th, Rocket Lab announced an $8 billion acquisition of Iridium Communications, combining rocket launch capability with a satellite network. Jeff Bezos' Project Kuiper was also right behind them. For the first time, Starlink's monopoly was facing real, aggressive competition. For a company sitting on $41.3 billion in historical losses, losing its only profitable engine is an existential threat. The skeptics were no longer whispering, they were shouting. Market historian Jeremy Grantham called the IPO the craziest he had ever seen. NYU. Professor Aswath Damodaran called SpaceX's $28.5 trillion market opportunity claim a hallucination. Morningstar pinned the actual fair value of the stock at around $62 per share, less than half of its trading price. This story was never really about rockets, artificial intelligence, or even Elon Musk. It is a great example of what happens when corporate hype completely detaches from financial reality. For a brief moment, the Trillionaire headlines were loud enough to drown out the balance sheet. The forced index fund buying was supposed to act as an unyielding shield. But gravity always wins in the financial markets. As Warren Buffett famously said, "Price is what you pay. Value is what you get." Elon Musk was a trillionaire for 4 days. But the investors who bought at the peak are still trying to figure out what the company is actually worth. If you want to look past the media headlines and understand how the financial system truly operates beneath the surface, hit subscribe. Because the receipts always come due eventually.